Well, hello everyone. It's Russell here from Enhanced Asset Management, and welcome to this reporting season video update. Well, twice a year, the chatter stops, the background noise dies down, and Australian investors like us get a clear picture of corporate Australia's health. It is this analysis that allows your investment team, to form constructive views as to what we believe may or may not happen in the future, and which ultimately guides our buying or selling decisions for your portfolios. Now, let me say that our expectations weren't strong at the start of this reporting season, and for good reason. Interest rates are at 12-year highs. Inflation, although it is coming down, has yet to be tamed. Cost of living pressures dominate media headlines. Bubble this, bubble talk that. It's back and it's everywhere. I mean, what a difference 12 months can make versus at the same time last year. But thankfully, I've got some good news to report. The February reporting season was arguably the first period in which we finally caught a breath of fresh air. While we're still seeing some COVID stimulus impacts coming out of healthcare, for example, the impact of billions and billions of government spending, interest rates at effectively zero, cheap credit everywhere. I could go on, but all these abnormal market distortions were finally and thankfully largely absent in this results season. It's literally felt like an eternity since we could get back to the basics and focus on core company earnings, which we're able to do again and which has us quite excited. As a bonus, it was clear that the market has started to refocus here too. Now, according to FN Arena, 36% of ASX 200 companies missed analyst expectations, 32% beat expectations, and 32% met them. Now, for stock pickers like us, a mixed reporting season like this is neither here nor there, but it was certainly a step in the right direction. Now, this can broadly be captured in the following chart. On the left-hand side, with the utilities being at the top of the pops, which helps explain our recent small purchase of AGL, for example. Retail was the next biggest surprise, with many names reporting reasonably well. But in saying this, we have expected consumers to temper their spending, and we can see demand cracks appearing, which is why we have been avoiding adding beaten down names to this part of your portfolio. But for now, the huge levels of net immigration numbers currently coming into Australia is keeping the sector alive and well. The standout for us was perhaps yet again information technology. And although it is a small sector in Australia versus the US, we do have some very high quality names in our index. And we believe we have excitingly uncovered a business that has a genuine potential to double in price over the next few years. That being Life 360, which we'll get Bowen to run through in a later presentation for you. Now, on the other side of the coin, with the exception of iron ore, which is now also under threat post-reporting season, miners and energy companies are struggling with lower commodity prices. Lower oil prices, coal and gas aren't helping, while lithium, nickel-based metals and aluminium are the weakest. There are also a few more indications of risks developing, with a weaker than expected Chinese economic outlook very much in the driver's seat for a lower commodity cycle going forward. But in saying this, with interest rates now having stabilized at longer term historical norms, we're left with basically what we know works. That is the trajectory of earnings. The current level of a business's growth, the future we estimate for that level of growth to be is back. And it's a large driver of share prices and hence returns, which has always been our core knitting. And in our final chart, which we show here, we can clearly show that a supportive interest rate backdrop, particularly if our base case for a soft landing holds for world's developed economies, we would expect a very favorable environment for mid and small cap businesses globally in the coming year, as these are typically the areas of the market that have historically performed well. Additionally, we harbour some thoughts that the growth style is looking somewhat overbought, particularly in mega cap tech, for example, which makes mid and small caps look even more attractive from a valuation standpoint, given their severe underperformance over recent years. So with that in mind, you may find that we'll become a bit more active than we have been in the past, particularly in these areas. So this is something to watch out for. Again, we are, post-reporting season, generally pretty excited, and we look forward to updating you again soon. But that's all for now for us. Any questions or feedback, please send them through. We're happy to hear them.